Not all products in the market are supposed to be exciting. Certain products like the bond market are meant to be boring, giving a fairly predictable yield. The moment the bond market gets exciting, the chances are that it can pull down the entire market. Now, is there a way to insure ourselves from a bond market collapse scenario? Welcome to credit default swap, a concept that very few retail investors understand. Stay tuned.
You have probably insured your car, your home, or even your phone. But what about billion-dollar loans made by banks and governments? Who insures them if they fail to pay back? That's where a hidden world of insurance called credit default swaps come in. The airbags of the bond market. A bond is just a loan. Someone lends money expecting regular interest and full repayment. But what if that borrower defaults, misses payments, or goes bankrupt? Aren't we told several times that the bond market is more safer than the stock market? However, unlike stocks, bondholders don't get a second chance. A default can swipe out everything. To manage this risk, financial institutions created the CDS, a contract that acts like insurance on a bond. Here's how it works. The CDS buyer, say a bank or mutual fund, pays a small regular premium. The CDS seller, say an insurer or another bank, promises to compensate if the bond issuer defaults. If no default happens, the seller keeps the premium. If default happens, the seller pays the loss. It's the same logic as car insurance. You pay a small fee to protect against big potential loss. Imagine you are an investor holding bonds of XYZ Corp. They have always paid on time. But lately, news about slowing sales and rising debt makes you nervous. You call your banker and say, I don't want to sell my bonds, but I want protection in case they go bad. The banker immediately advises, buy a credit default swap. It will cost you roughly 2% a year. If XYZ defaults, you will get your full money back. So, you pay 2% every year, nothing happens for 3 years. In 4 year XYZ collapse. While others panic, you are fully protected. That's the power of CDS. It converts uncertainty into a defined cost. Hence, always recognize that every market has a risk insurance layer. Stocks have put options to protect against price drops. Bonds have CDS to protect against defaults. As a retail investor, you don't need to trade CDS, but you should understand them because they show how professionals manage risk. So, the next time you hear spreads are widening or CDS prices are rising, remember, it means the market's insurance premium on credit risk is going up. It is a sign of fear, not greed.
In the next section, we will look at how a credit default swap gets designed and how it is approached in the US as well as India, because both these products have got a lot of impact on the outcome of the market. Thank you. Stay tuned.